Looking at another moving average use. In this lesson, we're going to look at how to use moving average crossovers. The learning objectives are: you should understand how to use moving average crossovers, and you should understand how to use moving average divergences. A moving average crossover takes place when a quicker moving average crosses over a slower one. Moving average crossovers help to identify new trends and get you into a position close to the start of these new trends, and therefore they can be applied to all time frames with some degree of success. More often than not, crossovers signify trend reversals and can give buy and sell signals. To break it down as simply as possible, when a short-term moving average, in this real-world example, the short-term moving average is light blue and the long-term moving average is dark red. So when a short-term moving average, the light blue line, moves above the longer-term one, which is the red line, it creates a buy signal. You can see that in this area right here, labeled buy signal. And when the shorter-term moving average crosses below the longer-term moving average, it creates a sell signal. You can see that here. Short time frame crossovers are good. They provide us with two moving averages tracking the price action closely, and it helps us it gives us a lot of trades. But because of the high number of trades it gives us, there are also a lot of false signals. Longer term crossovers are more significant than short term crossovers. An extremely common or well known one would be the golden cross, and it represents a major shift from bearish to bullish, with the 50 period moving average breaking above the 200 period moving average. At this point, the 200 period moving average normally becomes the major support level. On the other hand, the dead cross represents a major shift from bullish to bearish, with the 50 moving average breaking below the 200 period moving average, and the 200 period moving average becoming major resistance. This 50 and 200 combination has fewer signals. Nonetheless, the lack of frequency ensures that there are less false signals. I would suggest you use exponential moving averages over simple moving averages, because the exponential moving average gives a stronger weighting to more recent prices. As such, this will provide a more sensitive and dynamic signal compared with the simple moving average. Regardless of whether you use the shorter time frames or longer time frames, exponential moving average crossovers will give better signals. And because they give better signals than the simple moving average, they are used by many traders. And because of this, they have a lot more impact, and because of this, they are more likely to become self-fulfilling when they occur, particularly on the longer time frames. When the market is in an uptrend or downtrend, and the faster moving average diverges from the slower moving average at a wide distance, it indicates a rise in momentum. When the two moving averages converge, it indicates a slowdown in momentum. This gives you a warning in case you are holding any running trades to prepare an exit or tighten your stop loss. For the aggressive traders out there, you may want to enter a trade when the price is converging. That indicates a slow momentum, and a slowdown in momentum often leads to a reversal in the current price direction. In summary, moving average crossovers are helpful in identifying when a trend might be emerging or when a trend might be ending. Moving average crossovers provide trading signals that are easy to understand, and you can use it with any time frame and with any trading style. But the signal provided are often delayed, so you might lose quite a lot of pips before a crossover signal occurs. No moving average crossover combination will be profitable 100% of the time. You will always get false crossovers regardless of which type of moving average you use and which time frame you prefer to trade. Moving average crossovers are more suitable for longer term trading with exponential moving averages because short term trading with simple moving averages generates more false signals. But I will add this point. If you know what you're doing, short-term trading with simple moving averages can be equally, if not more profitable. But the key to it is discerning whether a signal given is a good signal or a false signal.